And good morning, and welcome to Money Matters. My name is Nev, and we are streaming live directly from Providence, Rhode Island, only on onedealaway.com. And boy, do I have a very, very, very important show for you today. If you have been betting on certain stocks, thinking market is going to open up, economy is going to boom, everything is going to be hunky dory, and we're all going to go back to the same old, as they say, going back to the normal. Do I have news for you to prove to you and show you how you potentially could be wrong and how the actual crisis is just about to begin? Right now, we have been dealing with the virus component, with the shutting down of economy, and the beginning pains were just the sort of start of a much bigger, much larger, much scarier component of what could happen, and that could potentially be the complete and total collapse of the financial market and finance, world of finance as we know it. I have been saying that we're having all kinds of problems within it and that we have to restructure all of this stuff. President Trump has been there have been news and rumors and stuff that, another Bretton Woods sort of needs to happen and we need to reorganize the finances around the world, not just in the United States, but globally. In today's show, I'm going to show you exactly where the problems lie right now and what we could expect to potentially happen as early as this fall, but all the way into next year. You absolutely want to and must watch this if you are wanting to at least a little bit attempt to protect your money. Let's do this. All right, y'all, and good morning. As I have mentioned, my name is Nev, and welcome to Money Matters Live. Yes, we are going live only on onedealaway.com/live. And I do want to welcome everybody watching this live on the website. If you are watching a replay on YouTube or any other channel, make sure you do subscribe. Make sure you do hit that like button and do hit the bell as well so you get notified every day that a show comes up. And we do this live every day. So every day you get a brand new episode of Money Matters. Now, today we have an incredibly important show that is going to show you why we might be sitting on a literal time bomb that is about to go off any second now. Now, I don't expect it to go off right this second. Okay, so you should relax, have your coffee, drink it, but do pay attention because what is looming in the economy is something similar to what happened in 2007 into 8 and then 9, but it's bigger. It is way, way, way bigger, and it has to do with something called CLOs. We're going to uncover what CLOs are, why they're so dangerous, what the problems lie, and how you potentially could think through and protect yourself through what might come and show up in our lives. All right, y'all. So here we go. This is what we're going to cover today. And I am noticing that I have lost some of the capabilities on the screen right now. And that's because I was cleaning up the computer without thinking that, it could affect what we are dealing with right now and what we're covering. So my apologies that the screen looks a little bit different. If you noticed it, I just noticed it myself. So there we go. I'm going to call it out so we can move on. All right. So here we go. Let's focus right over here on the screen of what's going on. The looming bank collapse. This is coming from the Atlantic magazine for July, August print. So we are a bit before everybody else because today is June 29th. It is a beautiful Monday. It is an important day and it is an important article to talk about. Now, the article is actually very, very interesting. I do highly recommend that you read the whole thing, but we're going to cover a vast majority of it. So if you don't have time to read it, well, that's okay because we're going to be covering just about everything within it, plus commentary, but yours truly. So here we go. Let's start. The financial crisis of 2008 was about home mortgage. Hundreds of billions of dollars in loans to home buyers were repackaged into securities called collateralized debt obligation, known as CDOs. In theory, CDOs were intended to shift risk away from the banks, which lent money to home buyers. In practice, the same banks that issued home loans also bet heavily on CDOs, often using complex techniques hidden from investors and regulators. When the housing market took a hit, these banks were doubly affected. Now, let's pause over here and kind of explain how and why. As you know, a lot of mortgage was given to people who simply could not afford it. They were, let's just say, lied and cheated to because they were promised that they were lured in by these like introductorily low rates where they, of course, could afford this small amount of payment. But the problem is that those rates reset, making the payments that much higher than ever before. What that did is then cause a large problem for the owners who all of a sudden went from $200 a month payment to $2,000 a month payment. They simply couldn't afford it, so they started defaulting. The banks were the lenders, but then they also bet on the other side of it, trying to double dip and make money from it. When the whole thing tumbled and went down, the banks found themselves in a short squeeze, meaning they were squeezed on both ends of the spectrum of the equation, losing a lot of money. And that is the problem that we ended up living through in 2007, 2008 fiasco with Lehman Brothers failing and, of course, all the other banks sort of falling down. Now, at that time, you will recall that the folks from the Fed and the Treasury went to Congress, were begging to basically borrow our money, tax money, and save these systematically important banks, banks that are too large to fail. The problem since then is that all of these too large to fail banks were actually being bought by other systematically important banks. And now we find ourselves in a situation where we have less banks, and all of them, just about all of them, are too big to fail. When and if those banks fail, we could be at a precipice of entire financial industry failing. Now, we're going to talk about, as we move on towards today's show, why it's not as easy to say, this is not JC's pennies. If they fail, it's not a big deal. We're talking about this affects every single living human being, every business, every investor, everybody in the world, because if the financial sort of system industry fails, we are all going down with it. All of our ability to borrow to buy cars, homes, education, pay our bills, all of that stuff collapses. And it might sound kind of cool. You were like, hey, does that mean my debt goes away? Maybe, most likely not. What it's going to do is going to shutter everything down. When coronavirus kind of came in and we started to shut things down, and you couldn't go in and you couldn't buy food, and toilet paper was on a short supply and all of those things, that is maybe 1% of what we could expect to see should financial industry collapse. So it is incredibly important and incredibly scary if you ask me personally. Now, in 2010, Congress passed a law called Dodd-Frank Act. Under the new rules, banks were supposed to borrow less, make fewer long-short bets, and be more transparent about their holdings. The Federal Reserve began conducting stress tests to keep the banks in line. Congress also tried to reform the credit rating agencies, which were widely blamed for enabling the meltdown by giving high marks to dubious CDOs, many of which were larded with subprime loans given to unqualified borrowers. Over the course of the crisis, more than 13,000 CDO investments that were rated AAA, the highest possible rating, defaulted. Now, this is incredibly important component here to remember as well, because one of the things that you also might remember from earlier shows, as well as what we're going to cover in a moment or reading it in papers, is that since the coronavirus pandemic, the Federal Reserve has started easing some of the regulations when it came to transparency and rules. You know, the Frank Dodd Act, excuse me, was requiring that banks are holding set amounts of money in reserves. Now, since the coronavirus, that actually has gone away, and we have a report from CNBC that talks about that there's the Volcker rule that is actually being eased. So we're switching articles just for a moment because they are connected and it's important for us to understand them. The U.S. banking regulators are about to ease restrictions created in the aftermath of the Great Recession, the 2008 component. Federal Deposit Insurance Commission, FDIC, remember, all banks are insured, but FDIC up to $250,000, which, by the way, they don't have money to insure all of us. So just something for you to be aware of. They might say it's a very cool marketing scheme, but in reality, they don't have enough money to cover all of us. Okay. Now, FDIC officials said in a call that they were loosening the restrictions from the Volcker rule, allowing banks to more easily make large investments into venture capital and similar funds. Banks will also be able to avoid setting aside cash for derivative trades between different units of the same firm, potentially freeing up billions of dollars in capital for the industry. Pause. Now, this is an important concept to talk about because what this basically means is that we have a law. Now we're going to basically say, forget that law. We don't need to worry about it. You don't need to worry about having some cash in reserves. You don't need to worry about going in and behaving like a hedge fund or a venture capital, right? Now, venture capitals and hedge funds do a little bit different or should be doing a little bit different than the banks. And, they typically go in, they put money into these small startups, which are super risky because vast majority of startups never make it. They just never make it. They fall because for all kinds of different reasons. So it's a super risky bet to take. And VCs, venture capitalists, or sometimes called vulture capitalists, just putting it out there, will go in and they'll put in quite a bit of money in, and they do fully understand that they can fund 100 different businesses, but they're betting that just one of them is actually going to take off, which is going to basically cover for all of the other losses. It is a highly profitable but incredibly risky behavior. And up until this point, the VCs could only get money from accredited investors, from people who actually have some extra cash to be able to put aside and sort of throw towards these things because they could potentially lose everything. Now, of course, they will do everything to protect all of that stuff from happening. The goal of a venture capital or a hedge fund is not necessarily to lose money, right? But they understand that there's a risk potentially to do that. Now we're talking about banks that are holding on to our savings, our checking accounts, and are going to be using our money to create some of these concepts. And of course, if it all fails, the venture capital company doesn't necessarily fail. I mean, sometimes they do, but typically they don't. It's just that their investors don't get the money. Now, if you think about it, that you and I, who actually have money in the banking system, are the investors who don't even understand. And on top of that, right, if I was an investor in a VC, I would put in $100,000, for example, right? And I could potentially lose all of the $100,000. But if I don't, I could turn that $100,000 into $1 million or 10 million, right? That's kind of how the game works. Now, in this particular case and instance, what they're looking to do within the banking industry with our money is that they will take our $1,000, but at the end of the day, if the bank wins, you don't get 100,000 in your bank account. You get your 1,000 back with maybe 0.01% interest. The bank gets everything else. So they take zero risk and get 100% of the reward. You and I, we take 100% of the risk and zero reward. Now, I don't know about you, but the game is rigged, and I believe that it's incredibly wrong and shouldn't be allowed. But yet again, here we are in what's going on. All right. The move is in line with the broad push by the White House to roll back regulations in place by previous administration. Lobbying groups and individuals, including JP Morgan CEO Jamie Dimon, have criticized part of the post-financial crisis regulatory regime as being overly restrictive or redundant. The Volcker Rule is part of the 2010 Dodd-Frank Act, we just talked about in Atlantic, which was passed in an attempt to prevent another financial crisis caused by irresponsible risk-taking at banks, designed to prevent banks from acting like hedge funds, right? That's what was designed. The rule barred banks from making potentially speculative investments using customer FDIC insured deposits. The change will allow banks to invest more of their own capital in venture capital funds that invest in startups and small businesses alongside clients. The move to relax margin requirements for swap trades between affiliates and the same company could free up an estimated $40 billion for the industry. As former chair of the FDIC, it won't surprise you to hear me say that the $40 billion that will no longer be in banks to protect them against derivative exposures will likely increase risk to the government. You want excess capital in the system towards the end of a cycle as you're approaching potentially troubled economic times. And boy, are we not approaching troubled economic times. Now, I'm going to bring you back to the Atlantic, because what I just explained to you is what the Dodd-Frank Act was trying to prevent. However, the banks were getting very creative even with it. Now we're going to see this go up tenfold, which is going to make things even scarier than what this article and what we're covering today is going to be. Not that long ago, about a year, maybe 2 years ago, I made a video that the next collapse likely will come from CLOs. And I still, to this date, stand behind that statement and that video that I have created and posted. I don't know that you can find it on YouTube per se, but it might be on one of the Facebook pages that I am managing or was managing at the time. All right. So now let's continue. Now, like CDOs, a CLO is multiple layer which are sold separately. There's the bottom, the middle, and the top layer. And the bottom layer is the riskiest. The top is the safest. It's if just a few of the loans in CLO default, the bottom layer will suffer a loss and the other layers will remain safe. That's sort of the overall goal. Now, the CDO is basically collateralized debt obligation, right? And it was a derivative that was created based off of the mortgages. The CLO is collateralized loan obligation. Now, if it sounds very similar, that's because it is. It is, but the difference this time around is that instead of the debt that is basically backed by the mortgages by regular folks looking to buy homes, the CLO takes the loan and basically creates this derivative from businesses. Now, one of the things that you might want to know and understand is that, when you and I borrow for a mortgage, we're borrowing, I don't know, $100,000, $200,000, right? When a business borrows, they borrow $1 million, 10 million, 100 million. So their borrowing is much larger. So CLOs are just like CDOs. They just changed the name. Debt and loan are pretty much the same thing, y'all. Look it up. It's exact same thing, just a slightly different way to put it. So they roll this puppy out. Now, the CLO market is bigger than the subprime mortgage CDO market was in its heyday. And we just explained why. And who is going in to get these CLOs? Well, who is getting it are the companies that are struggling financially as is. So we're not getting the prime companies that are going into this stuff. We're actually getting companies that are already struggling. They can't put additional stock on the market. They can't get additional bond on the market. And so they go in and borrow. Then the bank takes basically this whole thing in, scrambles it all up, packages it, and then sells it to investor. And then what you will find out from this article, they then create a special purpose vehicle. We talked about it. Fed does that as well, which is basically another sort of side company to get it off of their books, off of their asset balance sheet. And they create it. Then they use that company to buy the same product that they have created so that they can potentially make money again on both ends of the spectrum. Are you noticing a theme of what is going on, right? They did that with mortgage. They would lend on one end and then buy on the other side to try to win from both ends of the equation. Now they're doing the exact same thing with businesses and business loans. The CLO market is bigger. We just talked about that. CLOs have been praised by Federal Reserve Chair Jerome Powell and Treasury Secretary Steven Mnuchin for moving the risk of leveraged loans outside the banking system. But that is not really the case. So the writer of the article basically said, well, I have home mortgage with Wells Fargo. And so I decided to go in and take a look at what my bank is doing. I had to dig deep all the way to page 144. Nestled amongst the available for sale accounts, that is U.S. Treasury bonds, municipal bonds, and so on, is called collateralized loan and other obligations, CLOs. He decided to take a look, and Wells Fargo at the date total was $29.7 billion. That is a massive number, and it's inside the bank. This is the one that actually sits on the balance books. But remember, I just told you that they're also creating these side businesses that are using to actually do this stuff off the books. Okay? So this is very important. Since 2008, banks have kept more capital on hand to protect against a downturn. But in December, the Financial Stability Board estimated that for the 30 globally systemically important banks, the average exposure to leveraged loans and CLOs was roughly 60% of capital on hand. Okay, that is a huge number. Okay, and then now one of the things that you may or may not know is that when it comes to debt, credit rating agencies rank it starting with AAA, then you have AA, then you have A. Then you have triple B, double B, B, triple C, C, and C. Okay? Now, C stands for crap. Sorry for cursing, but that's just kind of how it is. Okay? B is not good. B is actually almost as bad as C. So, if you were to invest, you want something like AAA or AA, of course, if they're doing it correctly. Because remember, CDOs at the time were ranked as triple or double A. And they all basically collapsed because it was a load of crap. I mean, let's be honest, what it was. Now, what you will find out is something very interesting. You might assume that CLO must contain AAA debt if its top layer is rated AAA. Far from it. CLOs are made up of loans, businesses that are already in trouble. Fitch Rating has estimated that as of April, more than 67% of almost 1,750 borrowers in its leveraged loan database had B rating. Okay, B rating is lousy debt. Banks do not publicly report which CLOs they hold, and loan of concern in April were AMC Entertainment, Bob's Discount Furniture, California Pizza Kitchen, Container Store, Land's End, Man Warehouse, and Party City. Now, you might be thinking, wait a minute, I know the names of all of those companies, right? They're good companies. I mean, I ate in California Pizza Kitchen, and I shop at Man's Warehouse, or at least I did prior to the virus. Let's think about what these companies are. It's a movie theater. Well, they're shut down, right? Nobody's going out to the movies. California Pizza Kitchen. I just told you yesterday the California restaurants are still pretty much shuttered. And if they were to reopen, they can only open at 0.25%, then maybe up to 50%, and so on. So their retail, their income is not coming in. Party city. Well, nobody's throwing parties anymore, right? And if we do, it's sort of a drive-by, honk, honk, dance in a driveway, and you move on. We're not throwing parties like we used to. And when it comes to shopping, most of us are doing the stuff online because the stores are kind of closed, and the companies that own all these different products and services are basically saying we don't know how we feel about somebody else trying the shirt who might or might not have a virus, then somebody else tries it on, right? Levi Strauss, CEO, was talking about it months ago. Like, we don't know how we're going to do this. Do you require them all to try it? Do you have all of these different pairs that they can try, and then you got to wash it? So they were trying to come up with how do we solve for this stuff? And you also want to realize that many of the retailers and restaurants, they might have borrowed money to sort of go through the pandemic, but vast majority of them have filed for bankruptcy. Now, of course, in today's day and age, when thanks to Robinhood, when you file for bankruptcy, that's when your stock goes through the roof because people end up buying this stuff. We're just gonna call it stuff. That prices, but I know you thought exact same thing that I was thinking, right? The prices of AAA rated CLO layers tumbled in March before the Federal Reserve announced that its additional 2.3 trillion of lending would include loans to CLOs, right? So now you have a loan, up on a loan, up on a loan, buying a loan. Guys, this is a sort of like a 7-layer bean cake of loans or whatever the darn thing is called. Casserole, maybe? I don't know. Let me know in the comments or the chat, please. Help me out. Far from scaring off the big banks, the tumble inspired several of them to buy. Citigroup acquired $2 billion of AAA CLOs during the dip, which it flipped for $100 million profit when prices bounced back. Other banks, including Bank of America, reportedly bought lower layers of CLOs in May for about 20 cents on the dollar. Loan defaults are already happening, right? We already know that. We've been covering that stuff even on our channel here. There are more in April than ever before. Several experts told me that they expect more record-breaking months this summer, and I would say fall as well, into the winter. It will only get worse from here. Now, later this summer, leveraged loan defaults will increase significantly as the economic effects of the pandemic fully register. Bankruptcy courts will likely buckle under the weight of new filings. During a 2-week period in May, J. Crew, Neiman Marcus, J.C. Penney, all filed for bankruptcy, and they're not the only ones. We've been covering quite a few companies, and I'm sure that if you jump into your favorite browser, and you type in, bankruptcies and what companies have filed bankruptcies in 2020, you will get a list, and a very large list that is going to continue to grow. The insurance giant AIG, you might remember them from 2008 fiasco, which had massive investments in CDOs in 2008, is now exposed to more than $9 billion in CLOs. U.S. life insurance companies as a group in 2018 had an estimated 1/5 of their capital tied up in these same instruments, and pension funds, mutual funds, and exchange traded funds, most popular among retail investors, that's you and I, also are heavily invested in leveraged loans and CLOs. As you can see, this affects everybody. So if you have an insurance, if you have a bank account, if you have a pension fund, if you're investing in a market, if you have anything whatsoever, retirement funds, anything whatsoever financial, you are connected to the CLOs and the giant risk that is posing for all of us, because remember, it is a derivative that holds on to this debt stuff, that holds on to these companies that are pretty much zombie companies walking, meaning they cannot afford to service that debt, and they might and will likely have to go through bankruptcy, potentially completely disappearing, imploding this entire industry, and potentially shuttering the banks completely, making them collapse. Now, let's continue to find out what else can we learn focused on thus far are focused on CLOs because they are the most troubling asset held by the banks. Later this year, banks may very well report quarterly losses that are much worse than anticipated. Of course, everybody is reporting the losses. The big banks use similar structures called variable interest entities. This is that special purpose vehicles that we talked about that are created. These companies are established largely to hold off the books positions. Wells Fargo has more than $1 trillion in VIE assets, about which we currently know very little because reporting requirements are opaque. But one popular investment held in VIEs is securities backed by commercial mortgages, such as loans to shopping malls and office parks, two categories of borrowers experiencing severe strain as a result of pandemic. All right, let's pause and go back in to understand what does this actually mean. So I told you, banks are creating special purpose vehicles called variable interest entities that then they use to go in and basically buy these CLOs. But they're still holding it. It might be a separate business, but they're still holding it, right? So what ends up happening is that now they're taking this stuff, but they're also having commercial real estate. Now, if you've been following the channel, if you've been paying attention to what's going on, I've been telling you, commercial real estate is going down the drain, right? It is not coming back anytime soon and is going to suffer a big deal because when you have a tenant, such as a business, remember we talked about, who was that? Was it oh my gosh, what is the name of that company that sells high-end jewelry? The beautiful sort of like a turquoise boxes. Oh my gosh, no, it wasn't them. It wasn't them. Sorry, Tiffany. Sorry, Tiffany Company. It wasn't them. It was different sort of pretty color. It was the pink color. It was Victoria's Secret. Remember, I talked to you about it, Victoria's Secret, how they were going to the court saying, "Hey, we shouldn't have to pay the rent to the stores because we suffered this great thing, so we're not going to pay the rent." Well, when they don't pay the rent to the landlord cannot service that debt. So this is commercial mortgage. And remember, the banks are holding on to the mortgage side of things when they lend to the investor who has that building, right? And then the investor can get paid from the retailer because the retailer is not making any money. So now mortgage is not getting paid, so the bank gets squeezed over here. But now they also have a CLO that holds on to these mortgages that are trying to make money, so they're trying to double dip, and they're not getting money from anything because all of it is going to implode. Well, has a high potential to implode, okay? That is what's going on. When we talk about Wells Fargo, you will recall that it was almost $30 billion on the books. And now, from the article, we see that they have this variable interest entity that holds more than $1 trillion in assets. Now, this is sort of an interesting piece. Now, this is kind of what they were talking about, what potentially could happen. And you basically have the yellow ones are the triple B, and you will notice that there's like barely any. There's no triple A, double A, or even single A in here. There's like a handful of triple Bs, a few double Bs, mostly Bs, and then we have triple Cs or lower, which remember, I told you is bad stuff, right? Now, here is the hypothetical CLO from before the coronavirus hit. Each of the small boxes represent a leveraged loan color-coded by rating. Let's see if we can zoom this in, y'all. Ooh, we can. Excellent. Okay. Let's take a look. Okay. The lower layer of the CLO are the riskiest. The triple A layer is protected by the lower layer. So look at this. The triple A layer still holds all just B level stuff, right? B level stuff. Okay. This is the illustration of how our hypothetical CLO might have performed during the previous financial crisis, so during the 2007-2008 crisis. Many loans defaulted, but the defaults were limited to the lower layer. You can see kind of how the top basically stays more or less unaffected, while the bottom layer, we're starting to see the red, which red is defaulted. Now, they're taking us further. A hypothetical CLO in April 2020. Many loans have been downgraded by the rating agencies and defaults are increasing. So they're saying this is the AAA. You notice that some of the yellow has disappeared. You notice that there's way less of the light blue. It's predominantly dark blue. And then down at the bottom is some light blue, mostly pink, and quite a bit of red. now, here is the scary component and part of the whole thing. The worst case scenario, if present economic conditions persist or worsen, widespread defaults could hit not just the lower layer of CLOs, but the triple A layer as well. And you notice that entire thing, or just about the entire thing, turns bright red with a few pink, maybe a handful of dark blue, a dot or two in the light blue or yellow. Okay, that is beyond scary. And then sometimes in the next year, we will stare into the financial abyss, right? When the banks end up holding all of the stuff that ends up defaulting, now we're looking at too big to fail, about to fail. And last time we were able to go in, print all this crazy money, and try to dig ourselves out of the mess. Now, one thing that I do want to point out, in 2008, this is not in the article, this is just my sort of collective knowledge that I'm pulling out of my head. In 2008, an interesting piece that you need to know is that the GDP has fallen by 0.6 or 0.8%. And that was really huge. Now, if you will recall, we talked about it. They're expecting that GDP for 2020 is going to fall by 6%. Okay, 10 times as much. Okay, so if we experience that kind of panic and issue with potential financial collapse in 2008 at 0.6% collapse in GDP, and now we are looking at 6% even before the whole CLO, CDO collapse piece, you can only imagine the magnitude of what is going to happen. And the government might not be able to save us because before, in 2007, 2008, the interest rates were about 4%. We were able to drop them down to zero, print all this money, and attempt to dig ourselves out of the hole. Well, we are already at the zero right now as we speak. We've already printed and are printing $1 trillion a month, and we're looking at potentially $2 trillion a month over the upcoming months. So if this was to hit, we can't go lower than zero. Of course, we could go into negative, and I've been saying there's a probability that we might. Right now, Jerome Powell is saying that's not even an option for the United States, but I'm saying it could be an option when they get short squeezed, like the banks and the rest of the financial sector. Okay, then they're going to have to print, and it's not going to be 1 trillion a month or 2 trillions a month. We might have to look at 5, 10, right? Trillions a month. That is insane. If and when that all of that stuff unveils and unrolls, we are going to get that debt clock thing running faster than it is running right now. And let's take a look at the U.S. Debt clock right now to see what's going on with it right now, because I think it is incredibly important. Hold on. Let me change my screen. Let's see if we can zoom out. And you can see this thing. It's ticking. Look at this stuff. Look at this stuff. It is going bananas. It is going absolutely insane. Our revenue is $10,000. Our debt is $80,000. We're never going to pay that off. It's never going to happen. And you can see right now, I mean, look how fast these numbers are growing. This is insane, y'all. This is absolutely insane. Okay? Look at this. So, anyways, I wanted to share that with you. Now, let's go back to the article. The financial sector isn't like other sectors. We talked about it. If it fails, fundamental aspects of modern life could fail with it. We could lose ability to get loans, to buy house, cars, pay for college, or pay for anything else whatsoever. And regulators might need to dismantle the system as we know it. If we do manage to make it through the next year without waking up to a collapse, complete collapse, we must find a way to prevent the big banks from going all in on bets they can't afford to lose. Their luck and ours will at some point run out. Now, the part of the problem is that they're saying we have to prevent them from doing stuff, but we just eased it and made it even simpler. And I showed you that through the CNBC article that we talked about how the new regulation is actually easing stuff, not making it more complex and complicated. As you can see, this is a 600-ton gorilla sitting on the bank sheets, sitting on the balance sheets, sitting inside the room, hiding underneath the bed, ready to scare the daylights out of all of us at any moment. And this could be a huge and giant problem. And this is one of many reasons why I have been talking about a very high and likely probability that we might see a brand new financial system, definitely in my lifetime, but it could come as early as next year. I don't know that it's going to come this year, but it could come as early as next year. Now, we talked about all of this stuff. You might be petrified to learn all of these things, and you're going in your head like, I have insurance, I have a pension, I have a retirement fund, I'm invested in this, my money's sitting in a bank. What the heck do I do, Nev? Like, where do I hide from this thing? This is ridiculous, right? It's like an avalanche, and you see the potential that it could come down, and it starts to slowly kind of rumble and come, and you're like, where do I run? Where do I go? How do I hide from this stuff? Because once it hits y'all, it's going to hit, and it's going to take everything and everyone alongside with them. So, how do you protect? Well, unfortunately, there's no 100% proof way. So I'm sorry for the bad news, okay? But there are good news. Part of it is staying educated and learning about stuff and how you can protect yourself. The other part is looking for ways to invest that is outside of the system. And one of those ways is a physical precious metals holding, right? It gives an ability for you to hold on to some wealth, at least that when and if this thing completely implodes, you at least have some funds. The benefit of gold and silver, gold in particular, is that the gold tends to be much less volatile than silver, and they tend to be functioning sort of as money in many regards, as a sort of sound way of money. It's been used as money for centuries before this, and it is something that is widely accepted around the world. Just about anywhere you go in, you could easily, relatively easily, trade it and be able to still buy stuff. So that's number one thing that I kind of think about when I think about this stuff as a protection. Now, none of this is financial advice because I'm not authorized to give you. I'm just talking through my points of kind of how I'm thinking of protecting myself. A second way that I sort of think that this could potentially be a good sort of hedge and protection from it are going to be cryptocurrencies. Now, Bitcoin has been in many ways kind of correlated with the stock market. When the stock market goes down, that kind of goes down as well. It kind of crashes. Part of me thinks that because a lot of people are trading on margin and their futures as well that are sort of attached to the Bitcoin. So when the margins are called, they kind of sell one thing to cover another thing. So that's kind of what I think might be happening, but I could be wrong. Uh, but it also has an ability to kind of decouple. And I think that if a giant sort of calamity was to happen within a financial industry, that more people might decide to say, you know what, forget it, man. I need to get myself out of all of this stuff, and I need to get myself into an asset that has a potential to sort of withstand the stuff because it's outside of the financial system. It's running on algorithm, it's running on math, it's powered by people, supported by people, and watching that more and more wealthy individuals are going in it, more and more hedge funds, venture capitalists, and so on are starting to look into Bitcoin and cryptocurrencies. Lets me know that they might be thinking same thing that I am thinking. Now, I'm not saying bet the farm on it and put everything there, but you definitely want to look through things and consider of how you could actually protect yourself should this come to fruition. Now, part of the problem is that if a lot of your money is sitting inside the bank, and this Volcker rule does end up being eased up and end up being dismantled, so to speak, and the banks start venturing into the venture capital piece where lending money and buying into the startups, which again are highly, highly risky and highly illiquid, because it's not an open market out there. They basically wait for that startup to go and list on a stock exchange so that they can dump the money, make the money, and walk away. But while they're investing in that small business, it's highly illiquid. And if they fail, well, they fail and all of the money is gone. And the banks are going to be purchasing and investing in those things, gambling with our money. And I just told you, FDIC does not have enough money to protect all of us in the bank. So banks could collapse. There could be bail ins, bailouts, complete shutdowns, and complete rework of the financial system. And that is a very potential, and I would say even probable future of what we might experience. So there you go. I hope this is helpful to you. If you did like what you saw and what you learned, do me a favor, hit the thumbs up, do share the video, do subscribe to the channel, hit the bell button so you get notified when we go live tomorrow, or better yet, join me tomorrow at onedealaway.com at 7 a.m. New York time. Thank you for watching. We're going to jump into chat, do some Q&A, and I will see you tomorrow. Until then, stay forever money blessed, and do remember, you are only one deal away.